Ladies and gentlemen, welcome to the Future of Finance webinar series. My name is Phil Goldfeder. I'm the CEO of the American FinTech Council. The American FinTech Council is a standards-based trade association that has brought together everybody within the financial services, innovation, FinTech ecosystem for building out and working to build out collectively the future of finance that's built on regulatory compliance, consumer protection, embracing responsible innovation, and creating really the standards that will enable all of our companies to be successful, but even more importantly, for those consumers that are utilizing these technologies and innovative financial services, for them to ensure their protection as finance evolves. And so with that, we have an amazing, amazing panel today. And you always get a great panel when you want to talk about AI, right? It's sort of, you say the words AI and people come running now. It seems to be the topic of conversation all across Washington. We're actually seeing movement. For a lot of times, there's a lot of these big topics where you hear about it for years and years and years and nothing seems to move. And yet with AI, we're actually seeing a lot of movement, not just on the business and the consumer service side, but even more importantly, as we're going to get to today, as it comes to regulatory technology as well. And so that the regulatory compliance is keeping pace with the consumer service and access. And I'm going to let them all introduce themselves, but we have some amazing RegTech companies as part of our membership, and Winnow and SRA. Of course, Upstart is literally like the teacher now, right? It's just released. I don't want to steal Nat's thunder, but it's literally just released a new program for people to get certified. And of course, we could not do anything that we do without our friends, our partners at Orrick, and most of all, Jerry Buckley. I've known Jerry since the beginning of my FinTech career, and he has been a teacher, a mentor, sort of just someone who I've leaned on significantly and aggressively over the last 5 or 6 years. He has never let me down. And so, Jerry, thank you for committing to doing this today. Thank you for lending your expertise today. And more importantly, thank you for being kind of, a real steady, voice for AFC and me personally to lean on for so many years and being a big part of our growth and our success. So with that, Jerry, I'm going to kick it off to you, and I'm excited to hear what you all have to say today.
Well, Phil, thank you so much. And, as I've said before, it's obvious why you got elected to the New York legislature, because you know how to treat your constituents so well. Thank you.
Mean every word.
Thank you. And, it's very appropriate that the American FinTech Council, which is the leading voice for the FinTech lending industry, should be presenting a discussion regarding the power of AI to revolutionize financial regulation. We are fortunate to have a panel of close observers of how AI solutions are evolving in the marketplace and the potential they have to transform the way in which financial services firms are regulated. With us today is, as was mentioned, Nat Hoops. Nat is the head of public policy and regulatory affairs at the Upstart network, and we'll hear from him a little bit more later. Ed Vincent, who is the CEO of SRA Watchtower. Chris Hilliard, the Chief Executive Officer of Winnow, and Caroline Stapleton, a partner with me at Orrick, Harrington, and Sutcliffe. As some of you know, we at Orrick host a weekly podcast called RegFi, the premise of which is that, driven by technology, financial regulation will change more in the next 10 years than in the last 50. We're happy to have had Phil as an early RegFi guest, and in fact, Chris Hilliard and Nat Hoops have also been RegFi guests. It was one of our other RegFi guests, Raj Date, who stood up the CFPB as an agency, who suggested in his discussion with us that there be an A/B experiment in which financial services regulators would send out a team of examiners in middle seats in airplanes and conduct a traditional exam, sampling files, reviewing policies and procedures, and so forth. Meanwhile, that same regulator would select 3 of its best and brightest examiners to conduct a new examination using AI-enabled technology. And the regulator would then evaluate which method was more accurate in predicting the risk and behavior of the institution. It's not hard to imagine that one day in the next decade, regulators will have access to dashboards giving real-time data feeds on the activities of regulated financial services companies rather than relying on sampling methods, which give us month-old data once the examiners are assigned to visit an institution, or on call reports, which are somewhat bulky. A dashboard would start flashing amber when, based on large language model tested by the regulator, the data ingested by the dashboard pointed to financial or regulatory compliance risk. This is not to say that a flashing amber would cause everything to stop like a red light. It would obviously not be dispositive, but it would give an early warning to regulators who could then, in the human form, evaluate the problems which were identified by the AI-generated hypothesis. But before we get too futuristic, let's look at where we are now. Nat, Upstart has been in the forefront of developing AI tools to facilitate lending decisions. Now I understand Upstart has developed a course which will be available to both regulators and market participants to help them in the uses, benefits, risks associated with the use of AI in a financial services context. Could you describe that offering for us?
Sure, Jerry, and thanks for having us and AFC for hosting this session. I'm perpetually amazed at how far AFC has come and really excited to participate today.
Just a quick note, you certainly had an early role.
I just scraped the surface of what's happening now. I'll assure you, Phil is taking things to far greater levels. I will say our course at Upstart is pretty transformational in that no one else that we have seen has zeroed in on a financial services specific AI course that is really relevant for the universe of modeling and AI and machine learning, and aimed at the proper level. You could imagine how such a course could get too deep into the data science weeds where it would not be useful to practitioners in government or other forums where they don't have the appropriate mathematical or statistical background to appreciate it. And then you could also imagine a course that was so high level that it was basically just basic information about AI. And so I think we've hit the mark here with content that can really inform and improve people's capacity for using AI, managing AI, and doing so in a digestible format. So it is a new course. It's only been out for a couple of weeks, and we're nearing 1,000 registrations. So it has taken off really rapidly in the market. Modules. So foundational concepts in AI, understanding the models, ethics and oversight, applications in financial services, and next steps for applying AI. So I really urge everyone to take a look, and regulators are registering. So we've had registrations from FDIC examiners, CFPB data scientists, Federal Reserve employees. And so that is a good testament to the fact that people are eager for this information. They're eager to figure out how to be ready to grapple with the next generation of innovation.
Well, that is it's a very great service, and really great that Upstart has taken the lead on it. Now turning to you, Chris, most of us have used generative AI, have experienced hallucinations. Of course, when you look at examination reports prepared by human beings, we also sometimes wonder whether there have been hallucinations in that context as well. But in any case, I think we can agree that hallucinations are not desirable. I understand that you are experimenting with the use of generative AI to access the Winnow Legal Research Library at the state and federal laws. And I understand regulator representatives are checking Winnow out, as they are Nat Hoops's service. Could you share with us the advantages of using generative AI search tools in a walled garden like Winnow?
Yes, thank you, Jerry. I'd be happy to. And really quickly, thank you to the American FinTech Council and to Orrick for putting on this this webinar. It's a great topic, and I'm happy to be here. Hallucinations in the context of generative AI, for those of you that may not know what it is, it's where the AI produces information that's incorrect or fabricated, are a significant concern for everyone. The issue is especially critical when it comes to legal research and compliance, where accuracy and reliability are absolutely paramount. In our work within the legal research library at Winnow, we're exploring generative AI that is harnessed within a walled garden environment, as you mentioned, to try to mitigate these risks and provide precise and reliable responses to complex regulatory queries. There's several advantages to using generative AI in this way, and a few of those really I'd like to highlight if possible. And say first, that kind of walled garden approach, which involves restricting the AI's access to a specific curated data set, in this case, the Winnow Legal Research Library, which contains a comprehensive state and federal law inventory that's compiled by attorneys. So it helps give it a significant accuracy and whatnot. And by limiting AI's knowledge base to verified and trusted sources, we can significantly reduce the risk of hallucinations and still allow it to draw on a rich yet controlled data set, ensuring that the outputs are accurate and up to date based upon the legal information that's compiled. Secondly, generative AI in that controlled and curated environment can deliver truly tailored, fast answers to those queries, whereas traditional legal research can be time-consuming and requires extensive manual review of statutes and case law and regulations. However, with AI, we can help to quickly parse through those large volumes of legal texts and distill relevant information quickly and efficiently. And it builds in and enhances productivity in multiple different areas. And I would say that generative AI's ability to understand context is crucial, especially in the legal domain. The meaning and application of a regulation can vary significantly based on jurisdiction and precedent and specific circumstances. And by training the AI within that defined database, within that walled garden, vendors can ensure it's well-versed in the nuances and enable it to provide more contextually accurate and relatively precisely relevant answers. And it's particularly beneficial for compliance professionals who need to navigate those truly complex regulatory landscapes and ensure their organizations meet all the requirements that are applicable to them. And then kind of another advantage I would say is that we're able to implement feedback loops, and vendors are able to implement feedback loops where human experts can review the AI outputs and identify inaccuracies and provide corrections. And that iterative process allows for the AI to refine its understanding and improve its performance over time. Really just using generative AI within that controlled and curated environment, it just offers myriad advantages, and it mitigates the risk of hallucinations. It provides the fast and tailored responses. It helps understand and apply legal context, and it continuously allows for improvement. And it just benefits all of the users as well as the folks that are actually putting the information into the system itself.
Well, thank you. And Ed, so turning to you, the tools that SRA Watchtower has developed help fintechs and banks manage risk. They would, of course, have applicability in the regulatory context as well, as we've discussed with respect to the other technologies. Could you just take a few minutes to give us an illustration of how AI-enabled risk management tools might be employed by a regulator to evaluate the risk in financial services firm?
Absolutely, Jerry. And I'll echo Chris and Nat's comments. Firstly, thanks to Orrick for hosting today's conversation, and for the American FinTech Council, who continue to advocate for responsible innovation. Phil, it was terrific to have you on the SRA Watchtower Risk Intel podcast earlier this week when we were discussing the recently released third-party risk management guide. So Jerry, as you noted in your opening remarks, right, AI-enabled technology has the potential to revolutionize regulatory compliance. And we're seeing many AI-driven RegTech firms lean into this trend. I'll share one example. Historically, financial institutions employ large teams of people to perform anti-money laundering activities in the hopes of avoiding damage to their reputations, but also in meeting AML compliance regulations. Due to the arduous and manual work associated with monitoring transactions across multiple locations and platforms and products, right, AML teams typically take a representative sample of transactions and put these under a microscope. Right. Unfortunately, though, this introduces significant risk. Right. What if the sample was not truly representative of the entire portfolio? And what if none of the problem transactions are contained in the sample data set? The financial institution is subjecting itself to the risk that a regulator happens to encounter the problematic transactions during an exam, which obviously carries a negative and unavoidable consequence. So let's stick with the regulator and their exam for a minute. Instead of accepting that a bank-defined data sample is used, or even that a regulator comes in and provides their own parameters and the institution pulls a fresh sample data set, what if the regulator could evaluate the entire portfolio of transactions, eliminating the risk of pulling an unrepresentative sample and eliminating false negatives and false positives, and ensuring that each questionable transaction, in fact, receives scrutiny. Right? This increases the likelihood of catching a problem early when it may be manageable or resolvable. And this is precisely what an AI-powered AML solution offers, the ability to score and evaluate every single customer transaction. Now, banks have been a little bit slow to adopt this technological innovation, and one of the reasons is that regulators consider AI a novel technology, right, which subjects it to a different level of scrutiny. And on the heels of regulators making public examples of BaaS banks, financial institutions are certainly treading carefully in the AI space. This is evidenced by Ryan Hildebrand, the Chief Innovation Officer at Bankwell, which is about a $3 billion Connecticut-based bank, noted in an article this week that the bank considers anything related to AI to be, quote, high risk. And that he further noted that AI usage, procedures and policies are the key first steps before jumping into the space. According to a recent Business Insider study, about half of the banks under $100 billion in assets are currently using AI, which is lower than larger institutions. So banks considering these AI-related activities would be well suited to start by evaluating the maturity of their in-house risk frameworks and asking any partner who utilizes AI to share their AI risk assessments with the banks. And I can expand upon that a little bit down the line if desired. But with a foundation like that in place, hopefully the banks are going to feel more comfortable exploring AI themselves or working with AI-powered fintechs. And that maturity framework and that risk those risk assessments, there are some standards that have been published, and we can come back to that and how those would drive those assessments. But let me close, Jerry, by going back to your question there about the regulator. And what if the regulator actually embraced this AML technology that I mentioned themselves? What if they kicked off the exam by putting all of the bank's transactions, not just the sampling, through that level of scrutiny? This would seem to be a step towards improving the safety and soundness of the banking system. Now let's imagine if the bank expects to face that level of scrutiny, wouldn't it be prudent for the bank to evaluate all their transactions rather than a sampling before the regulator arrives? So, we've seen a couple of instances recently of banks receiving consent orders, and thereafter regulators approving this AML technology that I'm talking about as part of their remediation program. So perhaps we're left to ponder the chicken or the egg question. Should the banks embrace this technology first, or should the regulator employ it first? But either way, Jerry, I think that this AI-driven RegTech example hopefully illustrates that at some point, we're going to revolutionize regulatory compliance.
Very, very helpful. And, in each case where we've called on you folks, you sort of had some variation on the Raj Date theme that we should be looking to use AI in the regulatory context as a way of enhancing the way in which we regulate. Now, Caroline, you actually were a regulator. You started your career at the Office of the Control of the Currency, regulator of national banks, as our audience knows. And you've seen financial regulation up close in private practice and actually as in-house counsel as well. You now advise banks and fintechs on compliance with the use of AI serving their customers. Regulators, of course, are concerned that AI, both what I will call traditional AI and generative AI, could be used in ways that might cause consumer harm. Could you identify what issues AI raises front of mind for regulators, and particularly making some reference to the fair lending issues which you deal with so often?
Absolutely, Jerry. And pardon everyone, I have a little bit of a cough, so you may hear that. I'll try to go on mute if that happens. I think this has been so interesting what we've been seeing coming out of the financial industry regulators over the past couple of years on artificial intelligence, alternative data, and these issues of innovation, and kind of the shift in what we've seen regulators' approach to these issues has been. At the beginning, I think there was, some excitement that maybe we've found a way to be more inclusive, to make financial services be able to reach out and touch a broader population that previously hadn't been included in banking and lending in the ways that I think the government has wanted to expand and facilitate that expansion over the past several decades. The idea that maybe eliminating the human factor at some level could create less bias in the system if there were objective standards that systems could measure applications for credit, for example, or pricing, that would kind of remove this inherent bias that I think regulators have long believed exists at times within human beings, flawed humans. And what we've seen over the past, 5 or 5 years, maybe even more than that, but certainly over the past several years, is an increasing skepticism by financial services regulators of how artificial intelligence, complex algorithms, and other innovative technologies in financial services, how those actually might harm, in addition to potentially benefiting consumers and users of this system. And what we're in particular seeing is a concern about bias. We know that part of that is an administrative priority for this White House. We've seen that in multiple issuances from the White House, so that's tone from the top, that ensuring fairness, particularly in housing, but throughout financial services, is a super important priority. And so we're seeing that in the agencies themselves, the CFPB, the prudential regulators, the Department of Justice. And over the past couple of years, you can see that popping up in an interagency redlining initiative that's being spearheaded by DOJ, returning, to communities through lender required, not remediations, but settlements, requiring lenders to make investments in certain programs of over $100 million in actions against multiple institutions. And then just last spring, we had the Interagency Joint Statement on Enforcement Efforts Against Discrimination and Bias in Automated Systems. And that was a multi-agency issuance by the CFPB, DOJ, EEOC, and FTC, basically reminding anyone in any of the industries that they regulate that those authorities to take enforcement action based on the laws that those agencies enforce applies to the use of automated systems and innovative new technologies, just like they apply to any other practices. And in particular, what was interesting about that statement, because I think those of us who read it at the time were thinking, does this mean an enforcement action is about to come out? Like, is this the precursor to us hearing about, an AI in financial services enforcement action that will guide practices over the next couple of years? Well, we really haven't seen what I think I maybe thought was coming after that statement. We did see in that statement a point out of those areas that the agencies find most concerning, or the potential sources of discrimination, which would be data and data sets, model opacity, and access, and also model design and use. Is the model that you're using, even if it is sufficiently transparent and uses data and data sets that don't have bias, is it being used for the purpose for which it was designed, or is it being used for a different purpose? Has it shifted? Has that been tested and validated? And so again, this messaging continues. We've seen it pop up in appraisal bias. We've seen it pop up in concerns about adverse action notices, and even beyond subject matters and different types of financial services practices to more of risks and controls, right? Like how you're overseeing, how entities are overseeing third-party relationships. We just got last summer interagency guidance from the financial services regulators on risk management of third-party relationships, and understanding that what regulators are expecting is that if institutions are using a third party, in particular with AI capabilities, that these risk management principles are not just going to apply in some broad way, and it's not just some check the box thing. You actually have to take those principles and apply them to the circumstances that are at hand. And so that may be different for overseeing a third party provider of an AI system, right? And understanding that if you provide those services to a financial institution, that you may be subjected to a lot more questions than you would expect, because financial institutions are subject to so much regulation. They're going to be pushing that down the chain to their vendors, and that this is such a spotlight right now. So I think in terms of model risk management guidance itself, there's information out there that can show anyone here who wants to be able to prove to a financial institution, or conversely establish requirements for a service provider about model risk management. We have supervisory guidance from the prudential regulators. It's over 10 years old at this point. There is an OCC handbook on model risk management that has a bit more updated guidance from, I think, 2021. But this information is out there. It's about collecting it and then reviewing it from the lens of what are regulators worried about. They're worried that they are going to be, perceived as having given guidance that ends up resulting in an effect they didn't understand about, how a system would be changed and tweaked to follow that guidance, and then perhaps have an adverse outcome. So, I think we're getting more vague guidance rather than specific X, Y, and Z. Here's how you do it. And so functioning in that space is always more difficult. But at the same time, it does give some room for creativity, as long as you're, taking reasonable precautions to sort of play within the rules. So I think, and that's just speaking to bias. I also think, we heard a little bit earlier about hallucinations. That's certainly a UDAP issue. And one other thing I'll point out, and there are so many things I could talk about that the regulators are interested in, but one thing in particular that I think you see out of the FTC and maybe even CFPB too, is the representation that AI is being used in the course of providing a service, making that public representation and then not actually using AI, or using something that's not quite AI. That could be an unfair, deceptive act or practice, a UDAP, under the FTC Act. And so just to take care when you're representing that AI is part of the process. And on the flip side, we're starting to see states come out with bills, and I think in Utah, for example, most recently, laws that require disclosure of the use of AI in certain contexts for, where generative AI is being used in chats. So more to come. There's a lot happening, but I think the overall summary is proceed with caution, but proceed, because others are too. This is where it's headed. And so understanding where the guardrails are and making reasonable, justified decisions within those.
I love it, Caroline, that you make the observation, don't claim you're using AI if you're not, and make sure people know you're using AI if you are. So that other side of the coin is rather interesting. And Ed, I'm sure that you at Watchtower are confronting these issues with clients and helping them deal with them. Just any observation on, Caroline's pointed out the risks, the protections that might be available.
Yeah, thanks, Jerry. And I think Caroline is on the money there. That it's around proceeding with caution. I think that there's an educational aspect here of all the parties that are involved, the regulator, the bank, the partner. So that's part of it. Then there's a disclosure and getting this into a risk framework. That's certainly where we concentrate our efforts. And the folks at the U.S. Department of Commerce, their National Institute of Standards and Technology came out recently last month with some guidance on this front around how do you think about generative AI and what are the testing and the controls. We've taken that, we've combined that with some AI governance and risk management best practices. I think the NIST guidance was a bit more technical, and so we kind of put those two things together, and with an eye towards what would a framework look like that you were going to put in place, and that thing gives you a baseline, if you will, to communicate with the regulators. I think more than anything, right, you need to have a language and a way that you can communicate with them to show them where you are today as well as where you're going. Right, going in there with a blank sheet of paper and just hoping the conversation is going to bear fruit is a little dangerous. But if you can go in and say, look, we've taken a look at where we're at. There is some standards that we are taking into consideration. That puts you in a position, I think, to go back to Caroline's point, to say, look, we are proceeding, but we're proceeding thoughtfully. We're proceeding with caution, as Caroline said. This isn't haphazard. There's a methodology that we're utilizing to measure and evaluate and monitor risk on a going forward basis.
And the language, the word you used, talking the same language. I think that's really what you're trying to do with this course, is giving people a common framework for discussion. I think that's a hugely valuable contribution, and I'm sure that's.
Yeah, I think that's a big part of it. But I think Caroline just summarized all the guidance. Every bit of guidance, though, provides, and it's an incredible amount of guidance that's come out of all these different agencies. And the one that you missed, I would say, is that the White House in the executive order actually put out guidance that was a little bit more positively framed. It said, how could the use of AI tools improve compliance with fair lending and fair housing law? And so there has been some indications of a recognition that AI is being used to debias traditional models. There's a number of companies that have been launched specifically in that area. And there's also an enormous work being done by the regulators. Think about OCC Project Reach, where an enormous amount of the focus of that agency is on, how can technology improve inclusion from minority depository institutions that are supervised to a range of other practices within the OCC's remit that touch on this intersection of technology and inclusion. And so I agree, all of that guidance has been put out there. The course can help, that we've put out can help people speak the same language, but the AI revolution in lending and financial services is really here. I mean, we power more than 100 lenders. There's the news just comes out very frequently. You have US Bank, one of the largest lenders, partnering with Pagaya. You have announcements. I mentioned this in a prep call around Klarna and the use of AI chatbot. They have said they want to be the guinea pig for ChatGPT. So you have this, I think, real revolution. Zest AI put out results showing similar to Upstart, 40 to 50% improvement for Black and Hispanic applicants by using AI and alternative data in underwriting. And so I think as we look at this revolution that is here and all the guidance, every time a piece of guidance comes out, there's an opportunity to have a set of standards that then you go to your supervisor with. So if you're working with a third party on an AI lending process and there's new guidance for community banks, such as what the FDIC just put out on third-party risk management, you can go and document your entire program and say, this is how our program complies with this guidance, right? Or you mentioned the OCC handbook and the references on AI there. You can use those handbooks and say, this is how our program matches your regulatory expectations. So, as much as I would agree that some of the tone of these documents is proceed with caution, they also are guides for how to think about organizing your workflows, your compliance, your third-party programs, your customer success programs. For instance, just how often as a fintech partner do you need to be reporting work with your bank or credit union partner? So a lot of helpful things come out of these documents that can sort of on their surface seem like, big warning labels or things to be concerned about.
Nat, earlier in your career, you worked for a Massachusetts senator who was on the Senate Banking Committee, and later you led as was referenced earlier, the Marketplace Lending Association, which is a predecessor to AFC. And you're very familiar with the way in which Congress works, or often doesn't work. On May 21st, just 2 days ago, the European Union took the final step in enacting its Artificial Intelligence Act. Senator Schumer, meanwhile, in the United States, has led an in-depth discussion of AI risks and opportunities in the U.S. Senate with a bipartisan group, which has, which is somewhat uncharacteristic of the Senate these days. But this bipartisan group has been, really working hard on AI, as was mentioned at the beginning. You say AI, and people come flocking because they're fascinated by it, and they realize what an important factor it's going to be in our economy going forward. However, as in the related area of privacy, it appears that the EU has once more leapfrogged the United States and is leading the way, as they did with GDPR in the privacy context. Phil expressed optimism about our ability to grapple with AI. Do you think the United States can formulate a consensus around a set of principles that will govern AI development in the United States?
Well, it's a great question. I think they're starting from the right point. So our CEO of Upstart, Dave Gerard, was invited to participate by Senator Schumer in those bipartisan forums. And I think that forum plus the one going on at the House Financial Services Committee with McHenry and Waters are sort of promising indications that they're trying to move forward where there is consensus. They're trying to build a lot of knowledge, similar to what the course is trying to do for the sector, build the knowledge base of the legislature up to the point and the points of consensus up to the point where we could possibly see some bipartisan legislation, because I think that the concerns are move too quickly or move in a partisan way and you get nothing. And I think that there is a recognition that the AI revolution is a big enough deal. It's a big deal to quote Joe Biden in the health committee. This is a big deal. This
you
AI
can leave the adjective out.
we'll leave the rest of it out, but it is a big deal. And so if it is a big deal, then it's something that Congress is going to have some say about. And so if that's the case, how do you get to a point where they can do that? And I don't think they can do that coming from the numbers are too divided, House and Senate, to do that coming from anywhere but a bipartisan place. And so that's sort of the state of play. I think we're a long way away from seeing legislation, but as Caroline summarized, there's an enormous amount that's been filling the gap from the standpoint of, executive orders from the president, regulatory guidance, regulatory, reaffirmations that existing laws and regulations do apply, such as the adverse action notices and explainability requirements and so forth. So a lot happening. And then states are filling the void. So you have Colorado and Utah, as Caroline mentioned, coming with new legislation. So I don't see a near-term AI bill, but I do see a lot of productive work getting done on the Hill on AI.
Very interesting. The words of the close observer and expert. Chris and Ed, your companies have been providing tech-enabled solutions, sometimes using AI to facilitate compliance and risk management by your customers, many of whom are financial innovators. We're probably just at the beginning of the AI journey, although AI has been used in financial services industry for many years. There's an architectural principle that form follows function. And to analogize, financial regulation follows financial marketplace developments. As machine learning advances, do you see regulators following up on fintech innovation or, and we've touched on this before, holding back progress with placing danger or stop signs in the road to progress?
I mean, I think that we're at the beginning of a cycle again that we've been at before. I know this is taking us way, way back, but if you go back to 1994 when Fannie introduced Desktop Underwriter, and then you had a few years later the Housing Policy Council did a study on the impacts to low to moderate income individuals using Desktop Underwriter and showed a significant increase in approvals and underwriting times for low to moderate income individuals. We're getting the same type of thing now with AI, where they're looking at AI and we're seeing the significant impact that it has on low to moderate income individuals and the underwriting that it helps with. So it's just I just wanted to point that out. We're living history again, and oftentimes we'll hopefully we're not doomed to repeat some of the sins of the past. But kind of moving on to your question, Jerry, I just wanted to point that out. It's an interesting parallel that I was thinking about the other day. We're definitely deeply involved in providing tech-enabled solutions at Winnow and using aspects to leverage AI to facilitate that compliance and risk management for customers, like you pointed out, many of whom are at the forefront of financial innovation. And as we continue to advance that AI integration, the relationship between that innovation and regulation does become increasingly complex. And in my view, and in my hope, regulators are going to follow a balanced approach rather than strictly holding back progress, as you mentioned. I think it's important to recognize that regulators are aware of the potential benefits of AI, as we're seeing, with guidance, with comments, and with the feedback just in general in the press as well too. Machine learning can enhance financial services. And the technologies can improve efficiency and accuracy and accessibility, as I mentioned, and they offer significant advantages to both business and consumers. And I think that's the impact that we have to really look at as well too. I mean, AI can automate complex processes and reduce operational costs, driving down the cost of lending, and for compliance, providing real-time risk assessments, and which contributes really to a more robust and responsive financial system. And the regulators have a critical role in ensuring that those innovations don't compromise financial stability or consumer protection or market integrity. And they are often cautious. They are often looking at adopting a measured approach that allows for innovation while implementing safeguards to mitigate potential risks. And we're seeing that in the issuance of guidelines and frameworks and the encouragement. I think there is encouragement of responsible use of AI, and not just outright prohibitions. In many cases, regulators are, as we've seen, what we talked about earlier, actively engaging with fintech innovators. Upstart is on the forefront of that, and that's wonderful to have Nat on. And they're really trying to understand the implications of those new technologies, and I think they're really trying to develop informed regulations. I mean, regulatory sandboxes are a great example of that, and a clear indication of a collaborative approach. The controlled environments of a regulatory sandbox allow for companies to test their innovations under regulatory supervision, but they provide really valuable insights into how those technologies operate in practice and how they might be, effectively regulated. And I think there's a push and there's a drive. I know we'd all like to see an increase in the emphasis on principles-based regulation, focusing on desired outcomes rather than prescriptive rules. Having that approach and giving that flexibility needed to accommodate the rapidly evolving technologies that we have in AI, I think will ensure that the fundamental objectives of the regulation will take hold. Protecting consumers, protecting market integrity, and there hopefully will be very few instances where regulators might place a stop or a danger sign to prevent potential harm. They might target specific risks identified with ongoing monitoring and analysis, looking at algorithmic bias or data privacy and cybersecurity that may lead to more stringent requirements in those areas. However, I think that generally the actions intended to address those specific issues are not looking to stifle overall innovation. And we in the market and serving the market may not see their progress as fast enough or as encouraging enough of calculated risks. I think it's getting better in relation to the adoption of AI, but it's up to us to also better inform regulators, as a lot of the folks in this call are trying to do. We've got to be transparent, oftentimes radically so, with what we intend to accomplish and how we plan to do it, and what aspects are affected by AI and the ultimate impact on the consumer, hopefully for the better. We need to be able to explain this to our customers as well, too, in a manner they can easily understand and question. And I think by kind of fostering that collaboration and adopting a flexible, principles-based set of regulations, the aim is to strike that balance that supports innovation while still protecting the financial system and consumers, and as companies as well too. And that balanced approach really can ensure the progress remains open, albeit with appropriate checks and guidance to navigate moving forward.
Well, thanks, Chris. And I want to just mention one of the things that I in the context of a pro bono effort, interviewed the heads of innovation at all the financial regulatory agencies a while ago. And I think we're going to perhaps update that review. It was done on a non-disclosure of specific comments basis. But one of the things that we found, was that they had a hard time getting access to the technology to test it and use it themselves. It was a challenge because they have various procurement limitations and even limitations on their free use of technology. That's something that I hope Congress will take a look at, because they need to have access to what's available in the marketplace from companies like yours, and where they can use that type of and yours, Chris, where they can use it. Now, thank goodness, Matt, if I may ask a mercenary question, is your course available for free or for hire?
It is free as of now. So we'll see. It's free for now, maybe not free forever. So
but of course, so if it's available freely to everyone in the market, then I don't think that's going to be a problem for the regulators, and it doesn't appear in light of the fact that they're signing up that it is. But there are other technologies that are charged for the marketplace and have to be the agencies have to be very careful when they accept the free use of them. Ed, did you have anything you wanted to add there?
I'll just pick up, Jay, on your point about the regulators wanting to learn this. I mean, we've met with 3 different regulators over the course of the last 45 days who are asking for visibility into how our tools are being used. One of the regulators I mentioned, in that AML example, that's not our technology, but we're very familiar with it. The regulator now actually has access to some of that technology and is using it themselves. So I think they are trying. I think that they're to put the the Phil Goldfeder optimist hat on, right? And Chris, you were optimistic in your comments there. I think that there is a desire, but I will also though point out that the regulators still seem very, very comfortable using their danger signs. Maybe not their stop signs, but they're they are asking us to be thoughtful. I think if I were to try and mitigate that, I'd say education first and foremost, right? Everyone should be taking Nat's course. 2, I think standards help, right? Standard set of terminology with which to communicate and to evaluate risk. Thirdly, building the procedures and policies and getting those in place, and using a risk-based framework to evaluate these AI activities alongside the traditional enterprise risk management categories of credit and liquidity and interest rate and strategic, et cetera, right? AI should be in that mix as well. And so I think if you do that and then you go back and again re-educate those regulators. I mentioned the one-on-one meetings we've been having. We also spoke at an FFIEC conference last year with a room full of 300 regulators, right? It's incumbent upon us to go and find those opportunities as service providers into the space to do our part to educate and Jerry, I think as you said, to give folks access to these tools so that they can become familiar, whether they use those tools or at least they're familiar with how the banks themselves are using them. It just raises everyone's game when you go into those exam conversations.
Very.
Yeah, one quick point to build on that, Ed, that we haven't talked about but is important is supervision. So we talk a lot about regulation and guidance and rules and legal new laws being written in Congress in a lot of these forms, but we don't talk a lot about supervision. I think that's one place that's really ripe for the development and the use of some RegTech and AI tools. So for instance, Caroline, in ECOA compliance, if there's a fairer solution on the market, then in theory, a bank needs to ditch their old FICO-based traditional model and use the fairer solution. That's what ECOA says, if there's a less discriminative alternative approach. But I think the regulators struggle with not really having the tool to be able to evaluate whether or not, an Upstart model, even if we can show how it would enhance the compliance, the ECOA Equal Credit Opportunity Act compliance of a bank, to be able to look at, the results of our AI model or the hypothetical results of the AI model and actually back us up on that and say, hey, bank, I know that, you've been in the personal lending business for a long time, but your model is not as fair as the ones that are widely available in the market, and you need to up your game here. And I don't think the regulators, not that they would pick a winner or a loser, but even just to start to put that kind of equal pressure on the traditional systems that are used. And so I guess in supervision, I'd say one, down note that we're seeing, I think, unfortunately, is a lot of scrutiny on the newer providers, the upstarts of the world who are using AI. And even though, for instance, Fair Isaac Corporation, FICO, they are employing AI. They've made press releases saying we're using AI. And, you don't get the sense that a little community bank that's using FICO score in its model is being pressured to really understand the inner workings of FICO's AI, for instance, because it's a giant global, $12 billion market cap corporation. And so I think fairness and supervision as it relates to AI is a really important issue. And I think that we don't talk enough about supervision because that's really where the rubber meets the road on adoption. If a bank or a credit union faces any kind of negativity from their supervisor, that can mean a lot more than whatever guidance or rule gets put out. And so it's really important, Ed, as you mentioned, every opportunity we have to educate not just the leaders in Washington that write the rules and the regs, but somehow to get some of the knowledge down into the supervisory system of these financial institutions is huge. And that's one of the things that the AI course is really designed to do. The idea is that everyone can take the course, we can have that same level of knowledge or that level of sort of lingo, and then we can attack these problems if there are questions about explainability or questions about algorithmic bias or whatever. Here's how Upstart as a provider is dealing with those and building systems around solving them.
It's such a good point. I think a lot of it is structural within supervision because there are different supervisory teams who deal with larger institutions with a lot more sophisticated internal controls, functions, and compliance and legal. And then there's community and mid-sized institutions. And I think that regulators, you mentioned OCC, OCC in particular, but I know all the regulators are very focused on ensuring fairness in supervision, right? That smaller institutions aren't held to unfair standards that maybe a larger institution would be held to. But then in that kind of separation, I think you do see differential treatment that I think is intended to try to level the playing field, but is having the kind of interesting result that you're pointing out that maybe for larger institutions, there's a little bit more, we trust them to figure it out and do the diligence and use larger companies that are maybe more expensive, and that somehow that guarantees, better pressure testing and internal controls. That may not always be the case, and that may not simply be fair.
The advantages of incumbency. Caroline, our time is getting short, but I did want to ask you, there's a lot of concern generally about in the AI context about depriving human beings of real agency and turning everything over to machines. And yet, interestingly, in our space, as was mentioned, the Equal Credit Opportunity Act, the Fair Credit Reporting Act do require that you give the consumer an explanation that they can understand. And so I think that in many ways, financial services can lead the way in humanizing the delivery of services using AI. Any observations on that?
Jerry has the background knowledge of knowing I have so many thoughts about that. He and I have had a lot of conversations over the past year or two. One thought that I'll leave with everyone is this. Many of you may be familiar with the CFPB's bulletins or circulars over the past couple years talking about ensuring adverse action notices satisfy the regulatory requirements. You're not just picking the reason from the list that doesn't actually explain what your model is using for the criteria for decisioning for adverse action, even if it's complex, even if it's a black box. What Jerry and I have talked about is, could this go further than just checking the box for, regulatory requirements for adverse action notices? Could explainability help people make decisions that would improve their ability to, be approved for credit, for example? Could it help them change things to change their circumstances? And the thought experiment that I'm engaged in is, where's the line between using explainability to help and we're providing explanations and, characterized as, if you do this, this will improve your chances. Where does it cross the line to potential UDAP risk, right? We can't allow AI to do what a human shouldn't do, right? And if a human makes a representation that if you do this, you will be approved, the expectation is that if you do that, then you'll be approved. You might be taking an action like that would change somehow how you're doing things in your life. And so we would hold, I think, AI to the same standard. And so how good can AI get at being accurate when it's saying this is the reason for an adverse action, if you make this change, then the outcome will change? So that's the question that I'm exploring.
We're both exploring, but
we're both exploring.
But the idea of a dynamic disclosure that gives
Yeah.
people, that gives the borrower in real time, particularly for instance, in a mortgage context where someone is looking to get a pre-approval, if they could be getting data that would allow them to think about their circumstances and behavior, and whether you told them this will change your life, or whether you said, in many cases, consumers find that making these changes are helpful. It'll be interesting to see whether we can develop a solution that moves in that direction. I see that our time is up. We had other things we'd like to discuss, but I hope that we have been able to impart some interesting information to our listeners in to the American FinTech Council podcast. And so I want to thank our panelists, and certainly want to thank AFC for this opportunity, and Phil for his guidance at all times. Thanks.